Welcome to the Cover Your Assets podcast, a show for the physician who understands the importance of protecting everything you've worked so hard to achieve. If you're ready to find the peace of mind that only financial security can bring, let's get started. Here's your host, Billy Gwaltney.
Welcome to today's episode of the Cover Your Assets podcast. I'm your host, Billy Gwaltney. I'm excited to be with you today, as always. Today, we're covering the spreadsheet that I send to physicians who have asked for discounted rates or quotes for their particular situation. I work with physicians, helping them secure their private specialty on occupation disability coverage. There are 4 top-tier specialty carriers that offer this. The spreadsheet that you'll see on your video on the screen in the video if you're watching, or that you'll have on the spreadsheet in front of you that I'll go through. Those carriers are Mass Mutual, Guardian, Principal, and Emeritus. I'm an independent broker, work with all of them. They're very, very good. The devil is in the details for this coverage, as I say frequently. Depending on your specialty, certain carriers will stand out above others. I've just taken a sample from a female resident, neurology resident in Colorado that we sent this spreadsheet to recently. And this is her situation, her spreadsheet, her rates, and we'll just go through the key points here fairly quickly. What's worth noting is that if you're male or female, if you're 35 or 30 or 25, if you're 40 or whatever state you're from, the key points of this spreadsheet are the same. They're interchangeable. The rates will obviously be different depending on your age and your specialty and gender and so forth. But the key points that we're going to go over through today are essentially universal, regardless of what the ultimate decision you make is. And we do have clients with all 4. It's totally okay to pick any of these. If you've already looked down to the bottom, it's totally okay to pick the least expensive one or a less expensive one if you want. That's just driven by the trainee discount for your specialty and your age and so forth. Again, today we're talking about discounted true specialty on occupation disability coverage. And these are the alternatives. It's these 4 and no more. That's the first thing, is that this isn't the top 4 out of 20 or the top 4 out of even 5. It's these 4 and that's it. It's a kind of a weird landscape. These 4 are great. And then outside of these 4, it's like you fall off a cliff. From a quality or definition standpoint, it's all about contract language. It has very little to do with name recognition of an insurance carrier. That's not going to determine whether or not you get paid if you're disabled. If they advertise during sporting events, that's really not going to matter. All that's going to matter at the time of claim is the insurance claims people are going to pull out your policy and read the contract, and then ascertain whether or not your injury or illness meets the definition of disability. Or if you're residually disabled, does it meet the partial definition? If you're recovering, does it meet that definition? Does it have a recovery benefit, etc.? So walking through these key points, the initial benefit is we typically show $5,000 a month. This is for trainees. If you're an attending, your rates could be based on initial benefits that are higher. It could be $10,000, $15,000, $20,000, $30,000, depending on the amount that we're assuming or the information you've provided based on your income. But for trainees, the kind of starting point typically is $5,000 a month. Each carrier at different periods will change the maximum initial benefit for a trainee. Principals is $5,000. Mass Mutuals has recently gone up, and I think they'll allow $5,500 typically. It could be less than that depending on your situation. If you're close to graduating, you can get closer to $7,500. Emeritus will now allow anyone in training to get up to $7,500. There's no law that requires you to start at the higher amount. So with Emeritus, we pick one of them that will allow you to go down to $2,500 if you wanted to. And so again, there's no requirement that you start at $5,000. If you want to see different rates, we can send those to you. But this is to give you an apples to apples comparison. Worth noting is that this is an income tax-free benefit. So if you did receive it, you would not pay income tax on the benefit as long as you don't deduct the premium. Okay. So if you pay the premium with after-tax funds, then if you receive a benefit, it's non-taxable, state and federal. If you deduct the premium for some reason, which I haven't met an accountant yet that would advise that, but if you do, then if you do receive the benefit after being disabled, you would owe income tax on that. Okay. So, every client that I'm aware of does not deduct it. There may be some that do, and that's obviously their decision. But if you don't deduct it, then it's income tax free. The first line here is the elimination period. This is how long you wait or self-insure from the date the disability occurs until you get the first check. So you're looking at either 90 or 180 days. If you're disabled in January, you get your first check in either April or July. Okay, and you decide up front which one you prefer. There can be or you'll see down below, there's a cost savings if you wait 6 months versus 3 months. 6 months is quite a while when your world has been turned upside down and you've come to a complete stop and need money sooner than later. So, but some people are more comfortable floating because they trust their ability to keep cash on hand. And that's who the 180-day elimination is for. I would say the majority of clients will start at 90 days because you can drop back to 180 in the future. You cannot do the reverse. So the majority are going to typically start at 90, especially when they're in training. And attending that's looking at this might already have cash on hand and be comfortable with 180, totally a personal call. The benefit period is up to age 65. That's the maximum period of time that they'll pay for a disability. So it's important to make sure that your benefit, when you're purchasing your coverage based on your income when you become an attending, that you do typically go with the maximum or at least close to it, that they'll allow you to purchase because you still need to save money for retirement. It's not going to pay you for the rest of your life. It'll pay you up to normal retirement age. And that's typical. You could get a benefit period to age 67 or 70. It costs more for that. Most clients still tend to default to 65, but we can certainly look at those others if you want. The definition of disability, this is what starts to separate these four from everybody else. True specialty on occupation, that definition of disability is the best you can get. And contractually, it means two things. One, it means that if an illness or injury prevents you from performing the material and substantial duties of your specialty or subspecialty, then you get your full benefit. Okay. The second part is that there's then no penalty for income you later earn doing something different. Okay. So in this example, we sent this, I'm talking to a neurologist, a child neurologist. She is expected to go into clinic. She has a herniated disc in her back and cannot physically show up and go from room to room to room. Then she would be, if it's material for her to be able to physically be there and go from room to room to room, then she's totally disabled. She can then log onto her laptop and do telemedicine or virtual medicine and make an unlimited income doing that, and there's no penalty to her benefit. Okay, so it's the best definition you can get. If you're doing procedures and you can't, and that's material to what you do, and you also do clinic, and you cannot do procedures because of you hurt your hand or you hurt your back or whatever it is, then you collect your full benefit. You can then be a non-procedural specialist in that field and do clinic only. In other words, make an unlimited income doing that, and there's no penalty to your benefit. So again, it's the best definition you can get at the time of claim. The claims people will interview you. They would interview your employer and talk about those key duties. What is a typical day like for you? And then they would also talk to the physician that's overseeing your care for your condition, your illness or injury. And then that conversation, hey, can he do what they were doing before? And if the answer is no by your physician, then they're going to have to pay you. Again, it's the most comprehensive definition you can get. Again, these four do it, and outside of these four, it gets muddy very fast. The next line is what's called the benefit increase rider. This is what allows you to increase coverage in the future as your career expands, as your income goes up. Usually this would start when you're an attending, and each company has their own cap. Currently, all the caps for most specialties are 30,000 per month. There are certain specialties, surgical specialties, anesthesiology, emergency medicine, certain where carriers will limit that to 20,000 per month. So you want to factor that in and make sure you know what that cap is for your particular specialty, depending on the carriers. And that would certainly help you make a decision, likely, as far as which one's preferable. Mass Mutual Guardian and Emeritus now allow 30,000 per month for essentially every specialty. Principal will allow 30,000 for everyone except certain surgical specialties, and then, like I said, emergency medicine and anesthesiology. That's as of today. That could change. You want to make sure that when you're looking at this, that you get those details for your situation. The benefit increase rider allows you to increase coverage every 3 years as your income goes up. Okay. We have to update. You have to update. We help our clients do this. Update your income with the insurance carrier every 3 years. If you ghost them, if you don't do it, then they would take the benefit increase rider off the policy. And then if you are eligible for more insurance based on your income, there's a stipulation that you need to increase by at least 50% of that additional amount, or they would also take the rider off the policy. So an example is, let's say you're a trainee and you buy $5,000 a month. And then when you fast forward 3 years, as an attending, you now are eligible for $15,000 per month, which is certainly possible. Then the stipulation would be you need to at least increase up to $10,000 per month, or they take the rider off the policy. Okay. There are exceptions where you can increase coverage without having to wait 3 years. And that's when you recently graduated from training and become an attending. They'll let you do it sooner. Depending on the carrier, they may let you do it more than once. And so you would just want to look at that for your situation to determine if that's important to you. The calculation, when you're an attending, there is a formula that each company uses to determine how much insurance you can buy. They won't let you just increase to $30,000 per month because that's how much you want. You need to financially qualify for that. This coverage is, like I said, it's the most comprehensive on the planet. As a result, insurance carriers are pretty focused on making sure you're not overinsured. They don't want people getting too creative about how to become disabled, believe it or not. And so to get to $30,000 per month, your pre-tax income would need to be in the range of about $1.2 million. To get to $20,000 per month, it would need to be about $600,000, somewhere in that range. To get to $15,000 a month, you're looking at somewhere between $400,000 and $450,000, maybe a little less than $400,000. It depends, depending on the carrier. The ranges are very similar with all four, but part of the equation is any long-term disability that your employer provides. That factors into how much private coverage you can layer on top of that and get in addition to that. There is a linear cost relationship between the benefit. As you increase coverage, your cost goes up proportional. So if you 3x your coverage, you can expect to 3x the cost. The rates are fixed when you purchase them. So this particular example is for a female age 30. Whatever she buys at age 30 would stay at 30 forever or to age 65. If she increased her coverage at age 30, then it would be almost to the dollar linear. If she went from $5,000 to $10,000 a month, she would double the rate that she's paying. If she's 31 when she does the increase, then there would be a slight adjustment for being a year older on the increased amount. Okay, so the amount she purchased in training would stay fixed at age 30 to age 65. The increase amount as an attending at age 31 or 32 or 33, whenever she does that, would be slightly higher to adjust for her age at the time she does the increase. And at that point, it would stay fixed to age 65 as well. Okay. Hopefully that makes sense. I'd be happy to discuss it with you in more detail, but that's how the linear cost works. The next key element here is the enhanced residual benefit. This is partial disability. This pays if you can do your specialty part-time, but you can't do it full-time. So you could do clinic 4 hours a day, but not 8 hours, or you could do half the cases you were doing procedures on, but not the full caseload. So whatever you can do part-time, but not full-time because of an illness or injury, that percentage loss of income, they would pay that percentage of your benefit, okay? The 15% loss in parentheses here is the minimum income loss required to activate that benefit. So once you have been if you've been partially disabled and you lose at least 15% of your income as a result of that, then the residual benefit would kick in, the partial benefit kicks in. And whatever the percentage loss of income, they're going to match that from your policy, income tax free, okay? It's very important to have the enhanced residual or partial benefit in addition to the definition of total disability. So they go together. And then the third key element that's vital to this is right below it, called a recovery benefit. This pays if you medically recover from a disability and go back to work. But when you go back to work, your income does not recover to what it used to be. And that happens a lot. We have clients that have collected for over a decade from a recovery benefit because they're medically cleared to go back to work after being out for 2 years or 5 years or 8 years or whatever. But when they go back, they're starting over. And they may never be at the same production level, especially if they've built up a practice and they're in their peak earning years, and then they're out for 2 or 3 or 5 or 10 years, and then they come back, they're starting over. I mean, and it may never be what it used to be. So this recovery benefit is vital to have. And then whatever the percentage loss of pay you experience, they would pay that percentage of your benefit. Again, 15% is the minimum. With principal, you'll see that it's 20%, so lower is better. So principal's has a little bit higher threshold for the recovery benefit. But you're looking at, in the book I wrote, it's called Disability Insurance for Physicians, I talked about there's a 3-legged stool here, okay? And the benefit increase rider adds on to this, but the 3 non-negotiables to a really good disability policy are the definition of disability being the true specialty on occupation. Again, you can't do your specialty, you get paid, and then there's no penalty for doing something different once you're on claim. And then the residual or partial benefit being included, and then the recovery benefit being included. 3-legged stool. If you take one leg away, it becomes unstable really quick. Now that maybe is a corny example, but it's a good analogy for what we're talking about here. You can't, if you have 2 out of the 3, that's a deal killer. If you have a policy that doesn't have a recovery benefit, you need to look at how you're going to fix that. That's a key element of coverage. And again, outside of these 4, these things go missing, especially when you factor in the benefit increase rider that lets you scale up your coverage as an attending with these key definitions also included. That's important to factor into that. Okay. So, now, again, I'm happy to discuss this with you in more detail. I really just want to keep this going and not overstate it, but give you some baseline information, and then you can discuss it further for your situation. The psychiatric benefit, this pays for certain disabilities that are specific to depression, anxiety, ADHD, PTSD would fall under this. Carriers will limit this. For psychiatric disabilities, Mass Mutual's is 2 years per occurrence, okay? Not just 2 years cumulative, but 2 years per occurrence. Guardian is to age 65. They would offer this. You could drop that down to 2 years if you wanted to and save 10% on this rate down here, okay? But Guardian is known for this psychiatric benefit. This is one of their calling cards to the marketplace. And so if this is important to you, then Guardian is really good at that. Now, Principal does 2 years cumulative, Emeritus does 2 years cumulative, and then for 10% more on the cost, you can add that to age 65. They would give you the to age 65 psychiatric benefit. in exchange for 10% more on the cost you see down at the bottom of the spreadsheet. Okay. Principal technically would do the same thing, and so would Mass Mutual. But it does depend on your specialty: anesthesiology, emergency medicine. There's certain specialties where they will not allow you to have beyond 2 years. So you do want to factor this into your particular situation. We haven't seen a claim go beyond 2 years for a psychiatric benefit, but it certainly doesn't mean it couldn't. And so, that's not a scientific study. It's just anecdotal. But food for thought. As you apply for this coverage, at the end, I'll mention the streamlined medical screening that's required. One of the things they're going to do is check to see if you've ever been treated for depression or anxiety. And if someone has, then that can be excluded as a pre-existing condition. So just food for thought there. The next item is called the benefit advancement. This is unique to Emeritus, where a lot of clients like this. It's a perk. They will pay up to $500 towards any medical treatment you receive for minor injuries. And they just add it in. You're not paying an extra fee for this. So if you ever go to urgent care to get stitches because you hurt yourself working out or hiking or something, then they will pay you up to $500 towards that treatment, even if you don't pay anything out of pocket. Okay. So it's not a copay offset. It's just a $500 bonus check. You can make a profit on your injury. Okay. There's no limit to the number of times you can use it. We have clients that have collected multiple times, 3, 4, even 5 times from this. If that's important to you, then Emeritus is worth considering. Another perk that Emeritus offers that a lot of clients like is called the Good Health Benefit. This is automatically included at no extra fee. For every year someone has a policy with Emeritus and is not disabled, which is how they define being in good health once the policy is issued, is simply not being on claim, they're going to reduce the 90 or 180-day elimination period by 2 days. So that's going down 2 days per year. For this client, she's 30 years old. In 15 years, she's got a 60-day elimination, okay, for example, or 150-day elimination, and her rate stays the same. So she gets paid 30 days extra benefit, 30 days sooner, simply for having a policy with Emeritus, okay? So Emeritus is not always the cheapest. In this particular example, they are the one that, for clients that want kind of the freebies, like who gives me perks that I'm not paying extra fees for. Emeritus is a go-to for that. Okay. The cost of living adjustment is an inflation factor known as the COLA, cost of living adjustment, that factors in inflation once a claim is filed to offset the impact of inflation. So you can see that here it's available. It's not required to have. Each company, they have their own way of doing it. Mass Mutual and Guardian are going to increase the benefit by 3% every year, and they're going to compound it. Principal and Emeritus are going to base it on the Consumer Price Index, which is the U.S. national gauge for inflation. So it's not arbitrary. It's going to float with what inflation is, which historically has been at 3 or even maybe closer to 4%. So it's going to average at the 3%. But if it's 1%, you would get 1% if you had Principal or Emeritus. Down below at the bottom of the spreadsheet, kind of getting to the nitty gritty here, is the monthly rate for each carrier based on your preference for the 90-day or 180-day elimination period with or without the cost of living adjustment. Okay, so the cheapest option is the longer 180-day elimination without COLA. The most expensive option is the 90-day elimination with COLA. Now, as I mentioned, you can go from 90 to 180 in the future. You cannot do the opposite. Also, with the COLA, you can start with it and remove it at any point down the road, but you cannot add it, okay? So most clients, I would say, especially when they're in their 30s and training area age range, 28 to 35, they're going to, I would say 9 out of 10 are going to start with the COLA, assuming it's doable from a budgeting standpoint. Not everybody, but the vast majority, knowing that they can drop it back at any point, okay? I would say 60 or 70% around that range are going to start with the 90, knowing that they can drop it back to 180. But some are okay with the 180 because they're comfortable keeping cash on hand. So that's totally up to you. I don't debate people on which one they should do. I cannot advise you to wait longer or not have COLA. I can't go on the record saying that's my recommendation, because I would have some explaining to do if you complained about that, if you were disabled and didn't have COLA. So, they have to factor that in. But again, any of these are really good. There is, as I mentioned, streamlined medical screening for this coverage up front. When you're looking at one of these spreadsheets, the medical screening is easier for trainees than it is for attendings. Attendings typically have to do what's called an insurance physical, where they meet with a nurse and they do labs and measurements and those kind of things, but they waive that for trainees. So if and when you wanted to proceed with one of these, I would email you an intake form link to fill out some personal information, probably take you 8 or 10 minutes electronically. Then you would e-sign the application electronically, and then you would answer about 25 or 30 medical questions, either electronically or over the phone, depending on which company you pick. And that's totally up to you as far as which one you pick. Like I said, some are going to pick Guardian because of the psychiatric benefit, or Mass Mutual for the 2 years per occurrence. Some are going to pick Emeritus because of the benefit advancement, good health benefit. Sometimes Principal is the least expensive. Sometimes Emeritus, sometimes the others. It just depends on your specialty and your age. It also depends on what state you're buying the coverage in. This coverage is portable. It goes with you throughout your career. You keep it as long as you want to keep it. You can walk away at any time, so it's not a mortgage. You can walk away, but the insurance carrier cannot. Okay, the rate has to stay the same. The definitions have to stay the same. The policy cannot be canceled. These are all non-cancelable and guaranteed renewable. Okay, so they're the best coverage you can get. You can walk away. The insurance carrier cannot. The rate cannot be changed, and the definitions cannot be changed. And we do have clients on claim. They all get paid. Who your broker is does matter. The devil's in the details. These rates are the rate. There's no way to get these rates any cheaper than what you see here for what you're buying. Okay, the only way to get this rate any cheaper is to remove one or more of the key definitions, simply buy less coverage, or Guardian and Mass Mutual offer a graded or kind of stair-stepping, starts off cheaper premium that ultimately becomes much more expensive in the long run. Not advisable typically, but it's not a cheaper rate. It's just a lower starting point. It actually ultimately is a more expensive rate. So these rates, there are ways to get these rates higher than what I'm showing you here, because not all brokers know the definition or the key definitions or the discounts. The Emeritus discount is 31%. That's a combination of 3 different discounts. Principals is 30%. Guardians is anywhere from 10 to 30%, depending on your specialty. And Mass Mutuals is typically at 20%. The broker matters, not only helping you make sure you have the right definitions, making sure you're not paying a nickel more than you should, and then also making sure that you navigate the medical screening. They do underwrite a little bit different, so you would want to consider that before you apply. And then also the broker matters throughout your career as you increase coverage, helping you navigate that process. But also, if you ever have to use this stuff, the broker can be as involved as you need him or her to be. If you file a claim, it is important to make sure that you have someone on your team that has experience that can make sure that your file simply doesn't stay on the bottom of the pile, okay? But also to make sure that if anything needs to be cleared up, that you have someone with a lot of experience that knows the claims people to help clear that up. And we've been able to help move the needle with clients that needed help because they tried it on their own, figuring what could possibly go wrong. And some things went wrong and they got denied, and I got involved and got them approved. That happened twice within the last 2 or 3 years. So I'm passionate about that. My team is passionate about that, and we're good at that. So factor that in as well. I hope you found this helpful. I'm happy to discuss further with your situation. This is an overview. There is more to talk about. If you want to talk about student loan repayment rider or catastrophic benefit, those can be added. They're not required. They're certainly not always necessary. So factor that in, and happy to discuss with you. Please reach me. You can text me at 704-270-2376, and I would be happy to discuss with you further and schedule a time to do that. 704-270-2376. Thank you for your time. I look forward to the opportunity to talk with you further. Take care.
Thanks for listening to the Cover Your Assets podcast, an Odd Conduit media production. New episodes drop every 2 weeks. If you've enjoyed the conversation, subscribe, rate, and review this podcast. For more tips and advice, visit the website and YouTube channel. Check the show notes for links. Join us next time for another episode dedicated to helping physicians like you get your disability insurance right and protect your way of life.